Okay, so now we are in adjusting entries. So, not to scare you, but this part of the accounting cycle is another horror story of ABM students. Okay, this can actually get confusing, and the confusing part of the adjusting entries would be basically about the deferred expense and the deferred revenue, which I will be discussing in this video. Okay, so the purpose of adjusting entries is to be in conformity with the revenue and the expense recognition principles, that revenues must be recognized when they are earned, okay, and then expense must be recognized also or recorded when they are incurred, used, or expired. So there could be entries in the or initial entries in the company that would need an adjusting entry during the end of the period. Okay, and I will be discussing the two most confusing part, okay, in this video. So first is on deferred revenue. So first and foremost, let's define first what is deferred revenue. If you could remember, you were able to encounter the word accrued, right? So when you say accrued, just remember that you did not receive cash yet, but you have earned already, and you have already what you call this one, used if earned the revenue, and then used if expense. That is accrued. Okay, no cash involved. In deferred, when you say deferred, meaning there is cash involved already. So if it's a deferred revenue or deferred, I don't know what's the right pronunciation, but anyway, it doesn't matter. So if the deferred revenue, now I'm getting conscious if it's deferred or deferred. The deferred revenue would mean that you have already received the cash. There is cash involved. However, you did not yet render the service. Okay? Again, you received the cash, but you did not yet render the service. So that's an advance payment by your customer, right? And in our previous examples, we were used to recording that as unearned revenue. So meaning in our previous examples, we were actually using the liability method, okay, wherein we are very conservative when we receive the cash. Supposed to be, we should not call that a service revenue yet because we haven't earned it yet, because we haven't rendered the service yet. Okay, so we have used the liability method. There are instances that the companies use the revenue method when they record deferred revenue. Okay, and the adjusting entries in these two methods would be different. Okay, so let's have an example. Let's say received, okay, 50,000 cash for services to be rendered next week and next month. Okay, so the 50,000 cash is for the service to be rendered next week and next month. So if we use the liability method here, okay, so we will be debiting cash. Oopsie, what happened? Right, so we will debit here Shuki 50,000. Okay, and then credit unearned revenue 50,000. This is what you were used to, right? Okay, now let's say at the end of the period, okay, let's say this would now be the adjustment. Okay, so the problem would be at the end of the month. Okay, let's say 20,000 worth of services were rendered. Okay, meaning by the end of the month, we were able to render or do the service worth 20,000. Okay, so what is now the technique? So I will just put in bold this one. Okay, so what would now be our analysis? So what you do, you have here identify the earned and the unearned portion. Okay, if you could remember, this was cash received. Okay, that is 50,000, right? Okay, by the end of the month, we have earned, right? How much? We rendered 20,000. Meaning, the unearned is 30,000, right? Okay, easy math. Okay, so during the adjustment period, you should identify the earned and the unearned portion. Now, if you are using the liability method, okay, your adjusting entry would be to record the earned portion. So meaning your amount would be this one. This is what you will record. Okay, how do you record an earned service? You will credit. Earned service would mean that your revenue will increase, right? So your entry would be surely a credit to service revenue by this amount, 20,000. So its partner is the original liability that you use, which would be unearned revenue, 20,000. Okay, if you try to look at what would be the effect of this adjusting entry at the end of the period, okay, the effect would be our service revenue will increase to 20,000, which is correct since we have earned it already, while our unearned revenue, if you could see here, originally this was 50,000 credit, but we debited it, so 50,000 minus 20,000, the balance now of the unearned revenue would now be 30,000, which is what it should be. So that's the effect of the adjusting entry. It puts things right, that earned is only 20,000 and the unearned is only 30,000. Follow, that's for the liability method. Now, what if we use the revenue method? So, under the revenue method, okay, instead of crediting unearned revenue, meaning the company already recorded that as a revenue. So, that would be debit cash of 50,000, okay, credit service revenue of 50,000. Right, okay, let's say the same at the end of the month, 20,000 worth of services were rendered. Again, you still have to do the same. Identify the earned and the unearned portion. Now, if you are using the revenue method, okay, eyes here, if you are using the revenue method, what you will record is the unearned portion. So meaning this one, this will be your amount, 30,000. How do you record unearned portion? Unearned would mean an increase in unearned revenue. To increase unearned revenue, you will credit that one. So 30,000. That is what you will record under the revenue method. Okay? So meaning the partner would be service revenue and of the same amount. So this would be your adjusting entry if the company was using revenue method. So what is the effect of this entry in the company? Okay, so since you credited unearned revenue, it would now reflect at the end of the month that there is 30,000 unearned revenue, which is correct, right? Now, your service revenue here is credit 50,000, but you debited it by 30,000 here, meaning you decreased your service revenue from 50 by 30,000. It would now be 20,000, which is correct because your earned portion should only be 20,000 and not 50. So the effect of your adjusting entry would basically put the earned and unearned portion on the right amounts. Okay, that is now for a service or for a deferred revenue. Follow, okay? If there is a need to repeat this video, please do so. Okay? Also in the bottom part, I will be adding exercises on adjusting entries. Okay, so Don't worry, you just really have to practice. So that's for revenue. Let's go to expense. Ta-dang, ta-dang. Okay, don't be afraid. Right. Okay. This time, deferred expense would mean, again, deferred would mean there is cash involved, right? So when you say deferred expense, meaning you already paid cash, but you did not use it yet. It was not yet expired. You did not incur it yet. Meaning it is you who made the advance payment. Okay? Now, the usual thing that we do is we use the asset method. Okay? In the asset method, when you say asset method, what we debit is the asset. And when we say expense method, what we debit is the expense. Same here. If we say liability method, what we credit is the liability. If we say revenue method, what we credit is the revenue. Okay? So if what we were used to is this method, asset method. Diba, when we say we paid 6 months rent for, let's say, 60,000, okay, we record that as prepaid rent, and that is the asset method. So let's have an example, the same with revenue. So let's say paid, okay, let's use that, 60,000, the very legendary 60,000 for 6 months rent. This is a usual, because it's easy to divide. Okay, paid 60,000 for 6 months rent. So if a company is using the asset method, which is what you're used to, okay, which is the default way of recording, so this would be prepaid rent, debit, 60,000, right? Then credit, okay, cash by 60,000. Okay, now, during, let's say, at the end of the month, okay, at the end of the month, one month of rent was expired, right? And every end of the month, we usually do financial reports. So let's say, at the end of the month, let's have a, how did I write it here? So it's uniform. Okay, at the end of the month, okay, record the 1 month expired rent. Okay, expired rent is you have already used the 1 month, since 1 month has already lapsed, right? So what we do here, the same thing, identify the expired or unused, the expired or used, and the unused or unexpired portion. Okay, so we have here cash paid. How much was that? 60,000. Okay, and then used or expired portion is what? 1 month for 6 months, 10,000. Miss, how did you get that? 60,000 divided with 6 months, so 10,000. So meaning the unexpired portion is still at 50,000. Okay, so you know, according to the expense recognition principle, that when you say expired portion, we should declare this as expense, right? And if it's unexpired, we should declare that as a prepaid asset. Okay, moving forward, if we are using the asset method, okay, according to the adjusting entry, what you will record is the expired or used portion. And we debit the expense. So this would be debit, okay, rent expense, then credit, prepaid rent. Okay, to record the expired portion. Again, if we are using the asset method, what we will record is the expired or used portion, which is this one. This is what we will focus. How do we record expense portion? Debit expense. Or expired portion, debit expense. So, debit rent expense, 10,000. Credit prepaid rent 10,000. Okay, let's look at what's the effect of this adjusting entry in the accounts. So, after this adjusting entry, our rent expense will increase by 10,000, which is correct because we have an expired portion here. Then, our prepaid rent is credited, and prepaid rent is an asset. Normal balance is debit. When it is credited, deduct, right? So, meaning, from 60,000 debit, it was credited by 10,000. It would now be just 60 minus 10, 50,000, which is what it should be, the unexpired portion of 50,000. So, after the adjusting entries, the expired and the unexpired portion would be at their right amount. Okay, so comparing it now with the expense method. Okay, under expense method, okay, in recording deferred expense, we debit expense instead of the prepaid asset. Okay, so in the problem, this would be debit rent expense, 60,000, then credit cash of 60,000. So the same thing when we do adjustments, identify the expired and the unexpired portion. Okay, and if that would be expense method, okay, remember this one, that what you will record is the unexpired or unused portion and debit the asset account. Okay, so we will debit the asset account, which is prepaid rent, and the partner rent expense. Again, if that is expense method, what we will record is the unexpired portion, meaning this one. Okay, so unexpired portion, we will debit the asset, so debit prepaid rent by 50,000. Okay, rent expense, credit by the same amount because debit and credit must equal every journal transaction, right? What's the effect of this adjusting entry in the accounts? If we try to look at, after this adjusting entry, our prepaid rent would now be at 50,000, which is the right thing because unexpired portion is 50,000. Then our rent expense from 60,000 here, debit, okay, we credited rent expense. Expense as a normal balance of debit. If we credit rent expense, that would decrease the rent expense. So from 60 minus 50, it would now just be 10%, the rent expense, which is what it should be. Okay, so that's the effect of the adjusting entry. Again, do not be afraid. So if you would need to repeat this one, please do so. And I would be adding exercises so you could practice. Okay, adjusting entries would just really need practice. And if you were binge watching the videos and you were not practicing the journal entries and you go directly to this, you will really have a problem. So I advise you please go back to the journal entries and practice. Okay, I'll see you in the next lesson.